Hey everyone, welcome back to the channel. My name is Isaac and today I'm going to be giving you a complete guide on how to start investing in the stock market. Now, we've experienced massive gains in the stock market this year, followed by a recent turbulence, so a lot of people are interested in investing. This is meant to be a full in-depth tutorial that will cover many different sections, which I have broken down in the description below. I'll be covering everything from frequently asked questions about the stock market to which brokerage account to use to the stock market research that you need to do to be highly successful. While I highly recommend watching this video from start to finish, feel free to skip around to the different sections that are more applicable for you. Whether you're a beginner or an intermediate trader, you'll find valuable information throughout this video. I'd also suggest grabbing a pen and a piece of paper to take notes. Now, on this channel, we make a lot of videos of personal finance, specifically when it comes to investing and trading the stock market. So if this sounds like something you're interested in, all I ask is that you drop a like and subscribe to the channel. So first, I want to go over a brief summary of what we're going to cover today. We're going to start with mindset and the various ways to deal with emotions in the stock market. Then we'll take a look at several different investment strategies, specifically technical, fundamental, and ETF investing strategies. Next, I'll show you how to buy a stock. Then we'll talk about the different types of brokerage accounts that you can choose from. Then we'll talk about what a stock is, and then we'll go over the difference between investing in individual stocks and mutual funds. We'll take a look at the difference between passive and active investing to determine which strategy is best for you. Then we'll look at the differences between short and long-term investing, and then we'll cover the research that you need to do in order to find profitable investments. Specifically, we'll be looking at qualitative and quantitative research and what each of these entails. Then I'll show you my process for analyzing one of the stocks that I actually own. Next, I'll show you a more passive way to invest through dollar cost averaging. We'll also cover dividend investing as well as strategies to incorporate this into your portfolio. Then I'll go over the various tax implications associated with selling stock. I'll cover how much you should invest and so much more. So without further ado, let's get started. So the first thing we're going to cover is mindset and emotions in the stock market. Now, you may be asking, Isaac, why is mindset the first thing that we are covering? Aren't we just here to learn how to invest? Well, having the right mindset and learning to control your emotions are some of the most crucial factors when investing. Now, the stock market will especially mess with your fear of missing out, or what we call FOMO. Oftentimes, you'll see a stock blowing up by 60% in a day, and you'll get this fear that a stock is running off without you. Then you'll enter a trade while the price of the stock is high, while completely disregarding the fact that you have very low chances of profitability while buying at such high levels. Oftentimes, the market will trick you as well. You might see negative news coverage on a stock to help drive the price down so that institutions can get a cheaper price and drive it right back up. Obviously, the shorter your trajectory is on a stock, the more disciplined you have to be, and you have to stick with your investment plan, such as what percentage you'll take profits at or what percentage you'll cut your losses. One of the most important things to realize about the market is that anything can happen. Every single price movement is unique from one day to the next. Doing your own due diligence on the stocks, such as keeping up to date with news, earnings, and also charting your stocks, will help to give you an advantage over others. But since nothing is guaranteed in the market, all you can do is buy and sell based on your advantage while also having plans in place to cut losses if the price action of a stock does not move in the direction that you anticipate it to. Now, in order to help you guys, I want to share some of the rules that I followed, and if you all follow these rules, I guarantee that you will crack that mental barrier that causes most people to lose in the stock market. Now, the first one that I've alluded to before, and that is to not buy high in hopes of selling higher. You always want to buy low and sell high. Don't worry about those stocks that run off without you, because the odds of you being profitable while buying high and selling higher are not in your favor. The best investments are in quality companies that have been beat down so that there is essentially no justification for their drop in price. The second rule is to never put all of your eggs in one basket and to dollar cost average into your position. Like I said earlier, the stock market is volatile, so it is advantageous to diversify your holdings. Just because you may think that you know where a stock is headed doesn't necessarily mean that it will make its move immediately. It's important to dollar cost average into your position, especially when investing for the long term and placing longer term trades. And what I mean by that is, let's say you have $300 to invest in a stock. I will want you to split that money into thirds and invest $100 at a time. Let's say that you're bullish on a stock, or that you expect the stock to go up in the long term. I will buy $100 worth of the stock and wait a few days. If the price of the stock moves down, I will put in another $100. And if the price moves further down, I will put in my last $100. This allows you to average down on the price you paid for the stock, and essentially you would have bought the stock for a cheaper price. Now, my third rule is to buy the rumor and sell the news. Oftentimes when news surfaces about a company or sector doing well, stock price would have rocketed up and it would have been too late to enter a position already. Instead, you should be buying the rumor. For example, if there are rumors of a meat shortage and rising costs for meat, it would be reasonable to invest some money in a company such as Beyond Meat, which produces meat alternatives. My fourth rule is to stick to your plan. Let's say my investment plan tells me that I need to cut my losses at 10% 10% and realize my profits at 50%. If the price drops by 10%, I'm out. No ifs, ands, or buts about it. And if the price increases by 50%, I'm out and I'll realize my gains. What this boils down to is discipline, and the more disciplined you are in following your plan, the more successful you will be. So next we'll cover 3 investment strategies that I believe encompass a majority of the strategies out there. The first strategy is investing from a fundamental perspective. This means looking at things like the income statement, cash flow, and balance sheet. Fundamental investors tend to invest for longer periods of time, from several months to years and even decades. Looking at fundamental indicators such as strong earnings growth and a high multiple on those earnings can show the company's potential long before stock price can. And don't worry, I'll cover some of the most important fundamental indicators to look for when assessing a company later in the video. The second kind of strategy is a technical one. This means analyzing charts and looking at price action mostly on smaller time frames. This is a more advanced strategy that requires a lot of practice and discipline and should be reserved exclusively for intermediate to advanced traders. Technical traders typically day trade and look to take profits every single day. This is by far riskier than any of the other strategies that I have mentioned. Learning to read charts and recognize chart patterns requires a lot of education and practice. Now, I have several videos on my channel showing you various technical indicators and how you can recognize these chart patterns, so feel free to check them out. I won't go in depth on this type of trading on this video though, because this is especially geared to those just getting started to invest. The last strategy is investing in ETFs. These are publicly traded funds that include a large compilation of stocks or bonds that can be traded like a stock. Some common ones include the S&P 500, NASDAQ, and the Dow, which target different market segments. This is by far the most passive way of investing that is perfect for anyone from beginners to advanced traders. These require little in terms of research and maintenance and are great options for those who don't have a lot of time to manage their investments and also don't mind growing their money with these funds for years. Next, we'll touch on how to buy a stock. Brokerage accounts are investment accounts that allow you to buy and sell stocks. All of these require you to be over the age of 18, but if you are younger than that, you can open a custodial account. You just have to have a moderator, which can be a parent or other adult related to you, who can act as a moderator for your account. Some of the most popular traditional brokerages include Vanguard, TD Ameritrade, E-Trade, and Robinhood. All of these brokerages have apps that make it easy to access your investments on your smartphone. There are also automated brokerage accounts such as Wealthfront, which take out all of the guesswork and invest your money into stocks and ETFs automatically for you. If you'd like to set up an account, I have a link to Robinhood in the description below. I may receive some compensation if you sign up through the link, but I promise I won't be offended if you do a quick Google search for brokerages instead. Now, I won't cover how to set up your brokerage account, as these steps are very simple and self-explanatory and shouldn't take more than 10 minutes of your time. When registering, they'll have you fill out your personal information. Just make sure that you have your social security number on hand as well. Once approved, and this usually takes no more than several minutes, you'll be asked for your bank's routing and account numbers in order to fund your account. And that's it. So let's talk about the different types of brokerage accounts you can register for. There are many different ones that you can sign up for, but I'll talk about the 2 most popular types of accounts that will be most applicable to you. The first type of brokerage account that many of you are probably familiar with already is the retirement account. Now, based on your specific type of retirement account, you can either buy a predetermined portfolio of stocks or you can buy individual stocks, ETFs, and mutual funds just like a standard account. However, these accounts also carry tax advantages. Contributing to an account such as a 401k can help to reduce your taxable income, as this is money that is taken out of your paycheck prior to taxes. Others like a Roth IRA are funded with your post-tax money. However, you won't pay taxes when you withdraw after you turn 59 and a half. These accounts do have contribution limits, however. As of this year, the 401k accounts have a maximum contribution of $19,500 or $26,000 if you're over the age of 50. Also, Roth IRA accounts have a maximum yearly contribution of $6,000. With a retirement account, there are also rules pertaining to withdrawals, with most accounts forbidding withdrawal until retirement age unless you're willing to pay a hefty fee, not to mention that this money will be taxed as well. So the second account is a standard taxable account, and this is what most of you will be applying for. In this account, you can buy stocks, ETFs, and mutual funds. You will pay taxes on this account. So let's say you invest $1,000 into a stock and make $500. You'll be paying taxes on those gains, and these will vary based on the length that you hold the stock for. Now, we'll touch on taxes more later on in the video, but just know that for these standard accounts that you'll be paying taxes on any of your gains. In addition, there are no limits to how much you can contribute to this standard account. You can also withdraw your money anytime. So let's go over what a stock is. A stock is a piece of ownership of a company. I remember one of the first stocks that I bought was Snapchat back in 2017. I remember owning 5 shares worth a total of about $100. Now, a share is a unit of stock. These 5 shares represented a tiny sliver of ownership in the company. Let's pretend that Snapchat only had a total of 20 shares. The 5 shares that I owned would mean that I have a 25% ownership stake in the company. Sometimes when you own shares of stock, you have voting rights, which means that you have a say in company decisions. Next, we're going to look at the difference between stocks and mutual funds. As we discussed before, a stock is a sliver of ownership of a company. However, mutual funds or ETFs are essentially a basket of stocks. Let's say, for example, that you don't just want to own one stock like Home Depot. Maybe next quarter they miss on earnings or some misfortune hits the company and the price of the stock drops. So what some people like to do is instead invest in a mutual fund or ETF. Now, there are some differences between these, but for the purposes of this video, we'll just treat these the same in that they are just a basket of stocks. This is a way to protect yourself against the volatility of individual stocks and is a great set and forget method. Let's take a look at the VOO, or an index fund ran by Vanguard. This is an S&P 500 index that includes 500 companies. So when you invest in the VOO, you're essentially investing into this basket of 500 different companies. Now, there are other indexes such as the NASDAQ, which is a basket of primarily tech stocks such as Apple, Microsoft, and Google. These indexes can also function as a great way to gauge the health of the market. Oftentimes, we'll look at the S&P 500 to see how well the US market is doing. In fact, many countries have their own indexes such as the Nikkei 225 index in Japan, or the Italy Stock Market Index, or IT40. Actually, my investment strategy includes investing in a few of these indexes regularly, one of them being the VOO, in addition to individual stocks. Now, the reason why I like to diversify my portfolio by buying into these indexes is because let's say one of these companies goes bankrupt. Remember Lehman Brothers back in the day, which was a huge company that literally went bankrupt overnight and the stock price went to zero? Well, if you bought into an index which had Lehman Brothers as one of their 500 stocks, the value of the index wouldn't be affected by just one company going bankrupt. So while index funds are a safer way to play, your growth potential is also limited. Let's say one of the companies in that basket of stocks becomes the next Tesla and goes from several dollars to $1,000 over a few months. Well, in the same way, the index fund wouldn't move too much just because one stock blew up. So while index funds are ultimately a safer way to diversify your portfolio and limit your losses, they also prevent you from catching those companies that rocket up in price. Next, we're going to talk about active versus passive investing and the kind of differences between them, and at the end of this section, we'll see which one is the best fit for you. So I think you might already have an image of your mind of what an active trader is. Now, you might be thinking 10 screens full of stock charts, an expensive gaming chair, and a person sitting in a chair that doesn't really have a life but is probably filthy rich. Well, I'm here to tell you that it doesn't have to be that way, but I'll walk you through the kinds of expectations for someone who is more of an active investor. So an active investor checks their account at least several times per week. They are regularly reading the news, especially as it relates to the companies that they are invested in. In addition, they are also on the lookout for red flags such as price action on the chart or negative company records. This is why education is key for an active investor. You must not only know what the numbers on a financial statement are telling you, but you need to know how company news can affect a stock's valuation. You also need to know how to interpret price action and how to use past data to make predictions on future price movements. I know that this may sound really complex, especially to a new investor, but don't worry, because on my channel I teach all about how to assess a stock from their financials to the charts. Between learning about investing and managing your positions, you should expect to spend a minimum of 4 to 5 hours per week and even upwards of 15 and 20 hours. I know that this is a bit of a time commitment, but it's necessary to gain experience in the markets. There are several stocks like Beyond Me, or stock ticker BYND, that I know like the back of my hand, and I can tell you key company numbers and the next support and resistance areas on the chart right off the bat, but this is only possible with investing your time to learn about these companies. Now, if you don't have the time to put into learning how to invest, that's totally okay. I know a lot of you are busy and have a lot going on in your day-to-day life, and if so, it may be best option for you to take a passive approach to investing. One way is to dollar cost average into either individual stocks, crypto, or an ETF. So let's say you decide to dollar cost average into Dogecoin. What you could do is buy a few dollars worth of Doge every month. That way you're able to bring your average price down, especially if the price continues to fall. Now, with passive investing, you shouldn't expect to see immediate results, and this isn't a get-rich-quick strategy. You're ultimately investing with a long-term approach and should be prepared to wait to get returns on your investment. I have several videos where I talk about good stocks to buy and hold for years, so feel free to check those out. However, today we're talking a little bit more about active investing and strategies to help you be successful. Now we're going to talk about short-term versus long-term investing. We'll cover some of the differences between the two types, as well as a strategy that you could use for your investments. So short-term investments are designed for goals that are closer at hand and are a good way to take profits in the market on a more frequent basis. You might need the money to provide a stable income source, for example. Shorter-term investments such as trading can be inherently risky because you have less time for a stock to make its anticipated move. You also pay high taxes because if you sell your position before 1 year, you'll get taxed at a higher rate compared to stocks that are held for 366 days or longer. Typically, long-term investors will buy and hold shares based on the long-term trajectory of the company with larger anticipated returns. Long-term investing is good for those who want to take a more passive approach to the stock market, and this is what this video is geared to helping you master. This means that you're fine letting your money sit in the market for a long time while compounding interest. This is by far the safest method, as volatility in the stock market, such as corrections or crashes such as the one in March 2020, won't do much to impact the long-term trajectory of your holdings. Holding shares long-term also has potential for huge rewards. For example, imagine buying Amazon at the beginning of the decade, which has increased by 1,250%, or Domino's, which has increased by 3,000%. Investing long-term also carries tax advantages, which I will go more into in depth at the end of this video. Some of the cons to long-term investing is that growth can be slower, it can be boring at times, and investments into an account such as a Roth IRA can't be withdrawn until you are 59 and a half. Next, we're going to go and cover the most important step when it comes to investing, and that is research. Specifically, I'll be covering the two main kinds of research you have to do, namely qualitative and quantitative research. Also, if you don't have your pen and paper out already, make sure that you do now. So your qualitative research should account for 15% of your time you spend researching. You're going to want to research the CEOs of these companies. Are they owner-operators, or do they own a stake in the company? What transformative ideas do they have? Are they leaders in their respective industries? Is there any extracurricular drama surrounding these individuals? Next, you're going to want to ask yourself, hey, what does this company do? Are their ideas or technology futuristic? Are they closely following the precedent of successful companies? What's their business model like? Now, the remaining 85% of your time should be focused on quantitative research or looking at the numbers of a company. I want you to specifically focus on the Form 10K and 10Q. The Form 10K is an annual report. This includes the numbers from last year as well as projections for the next year. At the time I'm posting this video, you should expect to see these forms in the next few weeks, as they are usually released at the beginning of the year. If you want to look at the company's numbers on a micro level, the Form 10Q is exactly like the 10K, except it breaks down numbers on a quarterly basis. This can be especially effective in looking at how company announcements such as expansions into new industries affect their numbers. Next, we're going to talk about how to analyze a stock. Feel free to pause this video to save these URLs, but I primarily use CNBC and Yahoo Finance to do my research. I'll briefly cover what are, in my opinion, some of the most useful financial metrics, but I want you to spend time researching them, as you have to know how to interpret these numbers to choose profitable companies. Market capitalization refers to the total dollar market value of a company's outstanding shares of stock. This is calculated by multiplying the total number of a company's outstanding shares by the current market price of one share. Companies are typically divided according to market capitalization: large cap 10 billion or more, mid cap 2 billion to 10 billion, and small cap 300 million to $2 billion. When looking for companies that can blow up, we are looking for small and even micro cap companies, as these have much higher chance of high returns compared to companies with a large market cap. I went in deep on this topic in my video how to find stocks at 100x, so if you're interested in learning what numbers you should be looking at to find these stocks that have potential to blow up, then feel free to click on that video above. Total equity is the difference between assets and liabilities. This is a good measurement of the financial health of a company. What I like to see is that the total equity is increasing year over year. Margin is calculated by taking the gross profit and dividing it by the total revenue. High margin shows us that a company will become more profitable the more it sells. Companies can increase this net margin by increasing revenues, by raising the price of products or selling more of them. They can also decrease expenses and raise margins. Keep in mind that costs of advertising, research, depreciation, and development of new products can be included in the company's expenses. So what I'm saying is that not all spending is bad, and we typically like to see higher allocations to new project development and research, because the price of the stock may be affected in the short term since their costs are high, but if this expenditure is profitable, it can lead to a great long-term outlook for the company. For example, we recently saw Meta Platforms, previously known as Facebook, declare an allocations of tens of millions of dollars to developing the metaverse. Although this could cut into their margins, this initial investment could pay off handsomely in the long term. For our purposes, we want to see a margin of greater than 40%, although this can vary with companies such as Meta that have a good amount of their expenses tied up in research. Now, the PB ratio compares the market value of the stock, or how much it is currently trading for, to the book value of the stock. The market value of the stock is the share price multiplied by the number of outstanding shares. The book value is the difference between total assets and liabilities. The PB ratio is calculated by dividing the book value per share by the market price per share. When looking at investing in a company long term, it is helpful to look for a PB ratio of less than 10. This indicates that it is a value stock and it has a lot of upside potential. Now let's take a look at Tesla with a PB ratio of 27.1 and Facebook with a PB ratio of 7.24. Now, which do you think will have a better long-term growth outlook? In this scenario, if I was a long-term investor and my goal was to hold shares long-term, perhaps in my retirement account, I'd buy Facebook. A company's beta relates to its volatility in the market, and a value of less than 1 indicates that it is less volatile than the market, while a beta of greater than 1 indicates that it is more volatile than the market. Typically, your high beta stocks will also be riskier while also giving a greater chance at high returns, while a low beta stock will be safer but yield less return. Outstanding shares are the number of shares that are available to be bought. Stocks that have less than 100 million outstanding shares are considered low float stocks. I like to target these low float companies because when you have a lesser amount of shares that can be purchased, prices can stay high and increase more rapidly. Institutional ownership is one of my favorite metrics to look for when conducting fundamental analysis, as it shows what percentage of shares the institutions own in the company. Institutions include mutual funds, insurance companies, and investment firms. These institutions conduct oftentimes expensive financial research into a company before investing a large sum of money into it. Now, this is great for you, the retail investor, because it shows a good deal of faith that institutions have in the company, and the higher the institutional ownership, the better. I typically look to invest long-term in companies with an institutional ownership above 70%. So I'm going to walk you through a sample analysis of Boston Omaha, or stock ticker BOMN, and be sure to take notes as this will show you exactly how you should be doing your stock research. First, I'm going to look up the CEO of the company, and here we can see that it is Alexander Buffett, Rozek, and Adam Peterson. With our very search, we see that Alexander is actually the great-nephew of Warren Buffett. I like that family tree already. Next, we're going to look up a bit about the company. Here we can see that Boston Omaha is a holding company that owns billboards, insurance, and broadband networks. They are also planning on expanding into real estate development in Nevada, which should be another major source of cash flow. Right away, we can see that Boston Omaha is like Berkshire Hathaway. Like Berkshire, Boston Omaha has operating segments in stable businesses that will generate significant and steady cash flows. They have a really good track record of investments, as their $10 million investment into Dreamfinders Homes has now turned into $100 million plus. They are now in the process of acquiring a SPAC that will happen soon too. Next, let's look at some of the numbers. Here we can see that Boston Omaha has a 29.6 million outstanding shares, which makes it a low float stock. Institutional ownership is at 66%. These institutional investors actually hold a good portion of the company's stock. At the very least, this suggests credibility among professional investors and strong faith in the company by big money. With a market cap of 819 million, we know that this is a small cap stock, which, as we touched on earlier, has a greater chance of sizable returns, as growth, especially 100x growth, is more likely the smaller the market cap. Next, we'll go over to Yahoo Finance. On the statistics tab, we can see that Boston Omaha has a beta of 0.38, which means that it moves slower than the market, but it is also a safer value as well. It also has a PB ratio of 1.6, which is well below 10 and meets our criteria for a good long-term investment. Going over to the financials tab, we come to the income statement, and we can see that the total revenue has increased every year. Now, to calculate margin, we can divide gross profit by total revenue. In 2017 and 2018, we had a margin of 62%, and in 2019, the margin was 57%, in 2020, the margin was 60%, and the current margin for 2021 is 65%. All of these are above our sweet spot of 40%, and this shows that the company is quite profitable. Now, this is a really quick analysis of a stock that I'm invested in. I spend a lot more time going over different numbers, and I routinely keep up with news, quarterly reports, and earnings, but for those of you just getting started investing, I want you to copy my example and make sure that you know each of these metrics as well as the CEOs and purpose and trajectory of the company. Also, if you're a more intermediate or advanced investor, let me know some metrics that you pay special attention to that I may not have included here. So I want to cover an investing strategy that may be more helpful for those of you who may not have the time needed to be a more active investor. So for those of you who prefer more of a passive approach to investing, I want to introduce you to dollar cost averaging. This is a technique of gradually investing in a company instead of investing all at once. Now, this is a time-proven strategy that helps to limit your exposure in case of a negative event like a market crash. This is a great strategy for newer investors, as you don't have to constantly assess news and earnings reports for each of your investments, and it's really simple as picking a few quality companies and gradually investing over time. In volatile markets like today, dollar cost averaging can be a really good strategy. Now, some companies choose to give their money back to their shareholders. This is called a dividend. For example, we can see that Verizon has a dividend of 5% or $2.56. Now, they split this up over 4 quarters, so you can expect to receive a quarter of that every 3 months. This is usually sent as a deposit into your account. So instead of reinvesting your money, some companies will decide to reward shareholders. Real estate investment trusts, also known as REITs, can oftentimes see high dividends, with many around that 10% range. For example, take AG&C, which currently has a dividend of 9%. Also, stocks that offer dividends for the most part move up in price more slowly than other companies. A word of caution is that simply chasing high dividend stocks may not be that sustainable, and you should exercise caution with investing primarily in dividend stocks. Some high dividend companies may not be able to sustain their profitability, which can hurt dividends in the long run, not to mention that it will negatively affect investor sentiment, which oftentimes correlates with a drop in price of the stock. So just be careful when investing in high dividend companies, and my recommendation is to include a few very well-established companies that pay dividends into your portfolio. Now, personally, I would say don't have more than 25% of your portfolio invested into these dividend stocks. So let's talk about tax implications when you go to sell a stock. In general, you will pay more taxes if you sell for profit within 1 year as opposed to selling it after 1 year. The profits you make if you sell a stock for profit within a year are called short-term capital gains. You'll be taxed based on your ordinary income. However, long-term capital gains or profit made when selling a stock after holding it over 1 year are substantially less. This is still income dependent, but rates can vary from 0, 15, or 20%. Based on these two charts, let's say that you file as a single person and make $100,000 per year. Your long-term capital gains can be taxed at a rate of 15% compared to 24% for short-term gains. So how much money should you allocate to the stock market? This is one of the most common questions that I've gotten, and rightfully so. While I can't give you an exact figure, a general rule of thumb is to invest money that you are okay losing. If you have excess cash sitting around, I highly recommend setting up an account after this video. It will help you to get the ball rolling and get you over that initial hump of whether or not you should let go of that money and put it into the markets. I recommend setting a goal of how much you will contribute to your investment account every month. Make sure that you account for all of your basic needs and aren't using money that would otherwise be put toward necessities such as rent or loans. Another amazing rule of thumb that I like to use is that if I plan on buying a luxury item or an item that I don't necessarily need, then I will make sure to put that exact same amount into my brokerage account. So if I want to buy a $2,000 Louis Vuitton bag, I'll first put $2,000 into my account and then I'll go buy the bag. So what are some actionable steps that you can take right now? First, I want you to open a brokerage account. You can get free shares of stock by signing up through one of the links in my description below, and also helps to support my channel since I get free shares of stock as well. Next, I want you to fund your account, and it doesn't matter how much you contribute, just make sure that this is an amount that you are okay to lose. After that's done, it may take up to several days for you to access that money dependent on your brokerage account. So in the meantime, I want you to invest in your education. I recommend starting your investing journey with one of these books such as The Intelligent Investor and Trading in the Zone. Also, on this channel, I have a lot of free education, so feel free to check out my other videos that will help you to become more successful with your investments. So guys, thank you so much for watching this video, and I hope you got a lot out of it. I know it's long, but if you've stuck with it this far, I feel like this shows a lot in terms of how much you're invested in securing your financial future. Now, if you've got some value out of this video, please drop a like and subscribe to the channel to see more videos just like this. My goal for this channel is to provide free financial education specifically as it pertains to the stock market. Anyways, thank you so much for your time. Peace.